Like I said at the starting, with people at Merrill Lynch, and they were very interested in looking at certain frameworks for their clients and producing services, financial advisory services based on this line of thought. So the line of thought we started pursuing with them was first acknowledging mean variance doesn't work for individuals, primarily because individuals have a personal risk dimension which is not tradable, and so it doesn't figure into the mean variance frontier in which you find your efficient portfolio and you can go home happy. So the point being that if mean variance is not it for individuals, what do we need to do? So of course, if mean variance was it, then between these three portfolios, and what I'm plotting is, this is an artificially created three portfolios, for which I'm plotting the daily return. If mean variance was it, then these three portfolios, an individual would be indifferent between these three portfolios. Right? Because they have, as I'm telling you, they have the same mean and same variance. So now you can ask yourself, would you be indifferent between these three portfolios? If yes, then the normative world is good for you, and you can go home with a normative model. If no, then you have to tell me which one would you totally not be happy to accept as in your investment strategy, and which you will. So what's the word? The first question is, are you indifferent? If yes, then I don't need to ask you the second question. If not, then I need to know which one would you like, which one would you not like. So you need to understand what these are doing too, right? I mean, they're basically daily returns, right? And here, of course, you see that kind of scatter. Here is some level, and then here is some level, and then there are some deviations. So what's the answer for the indifference part? So you are not indifferent, right? I don't know who's talking. So yes.
We go for the portfolio one.
Okay, so first of all you're acknowledging that you see the difference between the three portfolios. So mean variance is not it for you, right? Okay, so and then for you the first portfolio is the best one. Okay, anyone else have which is the worst one?
I would say that the portfolio 2 is the worst portfolio.
Right, so the portfolio 2 has these very significant dips. Once you hit that dip, you never get to come out of it. That's the end of life for you. That's at least the end of your investment plans for you, right? Yeah, so the point, of course, this is an artificially created plot of returns, obviously. One of my students created it. And the message we wanted to get across is that mean variance is not enough. These three portfolios have very different characteristics. There is a significant downside risk in this, which a person would not be very happy to be exposed to. And there is a substantial upside potential here, which although it comes very infrequently. And that's the basic point. The basic point then is beyond mean variance, you want to layer up your strategy for your investment approach to cater to protection. That's one. So you obviously do want to, here is what I'm pointing to, you obviously want to keep up with the market, get some amount of good rides from the market. But on one hand, you also want to not fall with the market. Right? So you want some kind of protection, which was these big dips that you want to protect yourself from. But on the third hand, which most people don't have, but even so, you want some possibility, every individual wants some possibility of that likelihood of affluence, making it big. Nobody can deny that. Right? So in your strategy, you want to have these three components to be able to create a framework that gives you a solution that individuals can be happy about. Right? So the point being that mean variance is not enough. Let's acknowledge that and incorporate in our framework something that does more than what mean variance is able to do. So we want to construct, we have a view of constructing a layered portfolio or a layered pyramid view of creating a portfolio, keeping in the middle, keeping up with the market, at the bottom being a very, very averse to poverty, and then having the potential of high affluence. So what that will mean is that in our formulation of the so-called decision support framework, we would have to acknowledge that we have these three dimensions, acknowledge them by keeping structures in the framework that respond to those dimensions. Besides that, we will have to have asset classes that can help you achieve those dimensions. Right? So I have the personal risk, market risk, and aspirational risk, downside, mean variance, efficiency, and upside potential. And for each of those, I would have to define some kind of risk matrix. I've just written out a whole bunch of choices, and then individual needs to pick. All of this is really not in the normative framework, right? So we've walked away from structured, normative, rational utilities and being open to incorporate various forms which are actually catering to individuals' desires and needs. Okay, so I've hopped on into really putting out my optimization problem, which again I don't expect you to completely get a grasp of at least every element of it. But the point is that you're really deciding to assign investment into 3 buckets. The first is a protective bucket, which has a role to be played in these couple of equations here. The second is the market bucket, so it's the market portfolio. And the third is the aspirational. And you're doing this investment or making these choices so that a certain mean return is achieved, certain variance level is maintained, certain lower protection level is kept, that's the RL, the lower level of return, which is bounding below. And then this is the aspirational target. So the third asset is supposed to achieve some aspirational goal. So of course then I have to pick what specific assets might I have in mind for these 3 categories. And I have one set of market asset, whatever market index it might be, and a put option on the market index. So obviously we can all obviously understand which is playing what role. The market index is the market asset, the call is an aspirational asset, and the put is a protective asset. Right? So between these 3, I'm going to throw my problem at these 3 assets, and I'm going to throw the mean variance and see what both of them do, and how I evaluate the outcome. Similarly, I could replace the put by cash and market and call. So just 2 choices of types of assets I'm taking in the 3 categories and what they give me. So that's my framework, and that's the mean variance framework. So in my framework, I do assign a very heavy weight to the market asset, but then that's not it. I do assign a certain amount of investments in the protection world and the aspiration world. Same here, as opposed to the mean variance, which somehow completely ignores the protective part. Of course, I'm more curious about what it does to the behavior of the portfolio in every sense that I care for its behavior. So from the mean variance sense, because mean variance was, okay, I should probably also say that I solved my problem matching the mean from the mean variance and my framework, right? So my framework and comparing with the mean variance, I match the mean of the portfolio return. And then the mean variance will try to minimize the variance, and I will have all the other considerations in mind, right? So that's what you see here. I have the good outcome marked in red, and it's not a surprise that the mean variance will do better than us in the variance terms, because it is the only objective is minimizing is the variance, so we get the best variance, right? We don't do as well for variance because that's not the important criteria for us, but then for all other metrics these are, by the way, low percentiles and high percentiles of the returns of the portfolio. 80th percentile, first percentile, and this is conditional mean of first percentile, conditional upper mean of the 80th percentile. So we're basically protecting our tails of the distribution, or controlling the tails, not just mean and variance. So in all those terms, we do better. Similarly, in that portfolio, in the other choice of assets. So one key point that also comes to mind is looking at the entire distribution. Here I just pointed out certain estimates, certain percentile and conditional mean estimates. But to look at the entire distribution is an interesting story. So here I'm plotting the entire distribution of return from the mean variance portfolio and my wealth allocation portfolio, which is the modification. And that's the distribution. So the red one is the mean variance, and the blue one is our return distribution. So it's very clear what's going on here. Mean variance, remember, wants to keep a mean and minimize the variance, right? So the process of minimizing the variance, it doesn't discriminate between the downside and the upside. It just shrinks the distribution, right? And that's what you see here in the red plot. That's just shrunk the distribution, whereas our portfolio is seeking the upside. So where it differs from the mean variance is exactly where it should differ from the mean variance. It's allowing higher variance, on the good end of the distribution. Is this making sense? That's kind of the key point of this piece of work. Is that making sense? Okay, some nods are good. Okay, so moving on. I'm really moving on now. So I've actually walked through a few papers and giving you overviews of what we've tried to achieve in them. And I'm now really moving on into the third important dimension of risks that I was talking about. So I really walked through this bit, and I'm now going into talking about health risk and what at least in some extent, we have thought about in that context. So we at some point had acknowledged that health risk is a very significant component of risk that individuals have to respond to in their risk management strategies. And then we started looking at specific dimensions of it. The one key thing we have done in that dimension is actually looking at, well, this slide is not getting to it, actually looking at explicitly incorporating health risk in our decision framework. So this is just pointing to you that the sort of problems that I'm going to quickly display here are in the context of long-term care. And of course, long-term care now refers to requiring long-term of assistance in very fundamental activities of living, like cooking and moving around, bathing. So when people have very serious health events, they could be needing extended periods of care, not necessarily in a medical hospital environment, but maybe in a home environment they may need assistance for various very fundamental activities of daily living. So the ADLs, the activities of daily living, is a technical term for describing long-term care needs and the extent of long-term care. So of course, in response to the specific kind of cost implications for health care needs, there have been long-term care insurance products, and many of the leading insurance companies have been creating these products in the last couple of decades. So of course, these are privately purchased insurance, right? So if there's a privately purchased insurance, an individual has the responsibility to decide whether they need it or not, and at what point of time might they need it. Might it be optimum to get hold of one of these insurance products? Because, well, of course, they're not cheap. And then the counter side of it is that the cost of the care can be really, really high. And I'm, of course, right now speaking from a US context. So the cost of this care is really high, and so it's a genuine risk management question. So from our perspective, since we're looking at a strategic view of risk management from an individual perspective, the question to answer is, should an individual even consider this tool in their risk management portfolio for long-term well-being, where we are acknowledging that health is a primary source of happiness. That's hard to disagree. So as I was saying, that we incorporate the health-related risk issues in risk management from an individual perspective. We've gone ahead and incorporated an explicit health evolution model, and this is what I'm pointing to you in this slide. This is again picked from health economics literature, which is kind of simplistic, but it does have some good properties to capture the first order effect of health risk. So again, in a discrete setting, we are looking at health capital, so to speak, at any specific time point an individual has, and that in discrete time evolves at being better or worse, along with having certain shocks. So HT is the health capital at a specific time. It deteriorates in a normal sense by this term here. But then besides that, you could have certain health events that can cause a substantial decrease in the health capital. So of course, at the first sight, it looks simplistic, but then, for in decision frameworks, you have to make these abstractions to be able to answer the questions of importance. So the other point, of course, is in the health event term here, we would have to describe how that evolves. And keeping it really, really simple, we have two possible outcomes. So either you have a shock or you don't. Zero is the non-shock in the shock case. And for both of those, you would have to describe a probability of occurrence. And that probability of occurrence is a function of your current health and prior shock history. So in a sense, the model has a memory of health capital over time and how frequently or how likely the shocks might occur. So of course, the remaining problem in using this model is to calibrate it, which we've made a substantial effort into as well. But as of now, I'm going to use the model as a given and see and incorporate it in the decision framework. So when I start to incorporate it, I need to of course remember that now I have double, which was double from one primary sources of risk. One was investment, which I've already looked at all this time, investment returns, and the other is health risk. So these two branchings at each time point have to combine, and now you have a combined view of risk evolution in time. And remember, again, you have to observe this over a long horizon. So 5 years, 10 years, 20, 30, depends on how long you want to see and how long you have ahead of you to plan for retirement. But from a modeling standpoint, of course, it makes modeling and an optimization standpoint, problem standpoint, it makes the problem extremely more large. That, of course, is an exponential growth in the size of the problem. The other aspect of the problem is we are not done with the modeling, right? So if you have to make a decision of whether you invest, I shouldn't say invest, but maybe whether you buy an insurance policy, you also have to incorporate what is the impact of the policy, right? So what I have here is a premium and coverage model. So if you pick a specific insurance and its coverage structure, it will imply a certain premium structure which you have to be liable for. So we've gathered data from a few primary LTC insurance providers and created a regression model based on it. So that's part of the model, and the other model is, of course, healthcare cost, LTC cost. So again, we have used data from important well-known sources from healthcare sector in the US, and created a simple model for how how long-term care costs may be incurred based on the level of long-term care an individual may need. So that's the cost model versus the premium model and all the other models I had so far of how health evolves, how individuals make their investment decisions, consumption decisions. So obviously when all of this comes together, the problem is quite complex. So what I'm going to do now is really zip through the problem definition itself. So again, along with at least pointing to the most important aspects. So the most important aspect here now is you had from the earlier framework, earlier formulations, objectives that define how happy I am about my consumptions and how happy I am about my wealth at retirement. Plus here now how unhappy I may become because of very large cost of providing myself long-term care. And of course, hidden inside there is the decision of I purchase or do not purchase long-term care insurance. Right? So that's as an example of a type of problem we formulate to now use health risk as being one of the risk dimensions we want to respond to. So of course, we have the old decisions and we have a new decision of whether at which point in time in my life I'm going to buy the long-term care insurance. The parameter lambda is all important because it's telling me how heavily I'm going to weigh this aspect of decision in the context of the overall problem. And everything else is more or less coming from before. So, many more. And the problem also from a mathematical standpoint has become more complex because now it has continuous and discrete variables. The LTC insurance variable is a binary variable. You either buy it or you don't buy it. It's a 0-1 variable. Problems of that kind are a lot more in a certain setting, so I would have to describe at least a little bit of it. But most of it is actually coming from the way I was presenting results earlier. So I'm looking at the power utility, so I'm back into the normative framework. And I have a certain initial wealth level. And this is my constraint on wealth at retirement, so I have no constraint in this formulation. And that's the level of weight I'm putting to this long-term care decision consideration. And that's the outcome. I have no constraint on wealth, and if you remember from back then, I was being very risk-seeking. Or in other words, I was investing very heavily in the risky asset. So that is the same. But the consumption has come down, again, to respond to the fact that I have this affording long-term care consideration. So in that sense, the decision has changed and the wealth distribution has modified. And this is, you have to look at it a little bit carefully to see what this is saying. This is basically looking at the entire tree and then marking at which nodes you decide to buy versus not buy for long-term care insurance. So if you can just get a sense from it of how many black dots and red dots there are, you get to see how many places you're saying that you buy long-term care versus not buy. Right? So in this case, you very frequently manage to buy, and when you're not buying, you're actually not able to afford purchasing long-term care insurance. So which really means you're in trouble. Okay, so that being the first case, I want to then look at the impact of the parameter that was weighing how much emphasis an individual wants to give to purchase or non-purchase of long-term care insurance. And so I've increased that parameter, actually decreased that parameter to 2 levels, very, very insignificant and somewhat less significant. And then the point is that you don't know this parameter. Of course, in the end, you'll have to calibrate it from an individual. But then to get it in the right ballpark, that the problem actually becomes interesting, right? So to pick it very, very large or very small will not keep the problem interesting in seeing how a real individual might weigh one versus the other objective of the problem. So of course, this is making that distinction, and this kind of looks more realistic than this one, which is putting very little weight on the long-term care and hence not buying a very substantial number of nodes where it actually can potentially afford long-term care. Okay, so I think my objective here was to give a sample of results without getting a tremendous amount of insight of how to eventually make it usable. And that's the beauty of having a health model explicitly in the problem formulation, is because it tells you based on what your health level might be at retirement. That, by the way, is the time of retirement. 65 years is when individuals retire in the US. So at the point of retirement, we have 2 information, right? We know how much wealth the individual would have. We also know what is the health status of the individual. And that's a useful bit of information because health level at retirement is an indicator of how much more the individual can cope to be around. And that gives a sense of how much wealth should they be acquiring to be able to sustain life. And that information is valuable because that can be used to make this constraint we had on how much to save a little bit more informed. So that's what we have done here, to make a point that inclusion of health risk explicitly lets you address a lot more issues for the individual and make